Today we're going to hear from a good friend of mine, Josh Moorvitch, who's president and founder of JDM Funding. He's an expert in the field of lending, and we're going to hear what he has to say in this dynamic environment we're in right now. Super excited to welcome you to the show, Josh. How are you?
I'm doing great, thank God. How are you? It's been a while.
Yeah, it's been a while. You once again saved me on one of my commercial projects and worked your miracles and magic. So I'm like, man, I got to talk to Josh again about what's going on in the market because somehow you got your finger on all of it, and I really appreciate that.
Always a pleasure, and thank you again for that opportunity. I'm glad we were able to get it done.
Yeah. So maybe we could start off giving us a little bit of an update. You're the president and founder of JDM Funding. Maybe tell us a little bit about JDM and what kind of things you specialize in now.
So, JDM Funding Corporation, we're just coming up on our 14th year in May, and it's never been more interesting than it is right now in this marketplace. As JDM Funding, what we do here is all specialized and complex financing. Of course, we love the easy down the fairway. Hey, can I get a purchase loan, refi loan, something simple, whether it's in the residential space, homes, duplexes through fourplexes, or on the commercial side, we do all the shopping centers, multifamily, retail, all of it. But we also specialize in those complex, hairy, difficult transactions that people just scratch their head saying, yeah, I don't know if this is even possible.
I wouldn't know anything about those. I wouldn't know anything about those hairy deals.
Chad, you've got a gold medal. You've got a gold medal. You're a guru in real estate, and you somehow bring the most challenging deals, but we have got them done for you. So I would say, in general, JDM Funding is all about all financing in the residential and the commercial area. And then in particular, we're working on the complex stuff. And what really separates the way we provide financing from here, as opposed to maybe someone else, is I like to reverse engineer everything that I do. So that means I try to get into my client's head, understand really what's the goal, what's happening, and kind of work our way backward and see what is feasible in this project. What can we really do? And then we try to get common goals, and then my job and my team and have a wonderful group here in getting it done. And you've met some of that staff, and it's tough, it's challenging, but I love it. I love problem solving. It's fantastic.
Well, you nailed it on the head. Your team is great. We just wrapped up a loan probably 3 months ago or so now. We're filming this in March 2023. We wrapped it up. I want to say it was like December 30th because our offer was expiring on the 31st, so we squeezed it right in. But one of the things that I thought was crazy about this time around working with you is it seems like the requirements were quite a bit stricter this time around. And coincidentally, we were working on the same property. So I'm a very competitive guy. I'm not sure I'd want the gold medal for having the most challenging deal that you've had to get across the finish line. But I'll take the gold nonetheless. But it did seem like it was difficult this time around, not because of you guys, but because of the lending environment. And so I wanted to ask you a little bit about how, in your eyes, you do this every day, all day. How have you seen the lending requirements change over the last 12 months or so?
So I think this marketplace has become like bipolar, if that's even a fair way to assess it, where the environment is changing as opposed to where it was maybe every other quarter or on a more gradual basis. Things are changing daily in our environment. I would say the last 12 months, a year ago at this point in time, I think we were just wrapping up loans in the 3% range.
Wow.
And today we're lending at 7, 8, 9, and just depending on what else is out there, depending on the deal. So just on that alone, you're talking about over a 2x or a double on interest rates. So that environment has completely changed, which has also affected the values. If people can borrow and leverage the way they want to, people can't afford to pay those prices, it's automatically having an effect as well on the valuation. So we're seeing a more, I guess the word might be compressed appraised values, cap rates are going up, and it's having a bigger effect on the underwriting. So underwriters are trying to stay ahead of the game. So they're becoming more strict in their underwriting. They're stressing deals a little bit more, and that is having a bigger effect in the transaction itself. So in this deal that you just completed, which was office medical, still, because of rollover leases, depending on what the cap rate is and what's the cash flow, that environment is just getting more and more difficult. They want to pad it. They want to make sure that if there are things happening in that property, that in 6 months out, 9 months out, 12 months out, where this environment will continue to probably hang a little bit tight, that they're in a good position as a bank. And I also think in general, there's a lot of pressure from audits on the lenders and their banks and on their portfolio and what's on their assets on their balance sheet right now, to make sure that everything that they're putting there is legit, it's clean, people can make their payments, they're not making very aggressive bridge type of loans that aren't going to work out well. So we avoid what happened in 2008 and 2009.
Yeah, got it. Yeah, and going back to the office medical, because that's a good example. I'll speak to that just because it's one of the buildings that I own and manage. But it was, our mortgage payments a year ago, right? We're filming this March 2023. So March 2022, my mortgage payment was $12,500 a month on that building. And we started getting the increase letters, just like a lot of people got from being on a variable rate loan. I didn't have an interest rate cap on it or anything like that. And inside of 8 months, that $12,500 loan went up to $17,500 loan. And actually, the month we closed, which was in December, I didn't mention this to you, I got another increase letter from the bank, even though we had just closed. Like it was just, it was like overlapped, if you will. It went up to $18,600. So I had a 50% increase in that mortgage payment inside of a year. And from working with you guys, we were able to do a fixed loan, 5-year term, and it brought it down to $14,500. So it was a huge savings for us. I mean, yeah, it was higher than it was back in March a year ago, but I would have been at $18,600, and you got me a fixed loan, $14,500, huge savings from where I was at. I'm very appreciative. As you know, we went out to lunch and I told you how appreciative I was. And it was amazing. So I know JDM does great work. I know that you're on top of it. And so just super excited to talk to you about this, but just the sheer speed at which those mortgage rates and interest rates were increasing was phenomenal. I mean, something I've never seen before. I'm sure you've never seen it in your time either, but it's painful. So and we may allegedly have had a bottle of scotch involved in getting the deal done. Allegedly, it's yet to be determined, but
I don't know what you're talking about.
you got to get creative on these things, right? So yeah, you and your team did great. And speaking on some of the creative side of things, are there some things that you're able to do now, or things that you've had to employ? I'm not talking about bottles of scotch or anything, but are there creative ways that you're able to do financing? Because you and I are both SC Trojan guys. I'm very much think the way you had mentioned earlier, like sometimes you got to start at the end and work your way backwards to find the solution, almost like solving a maze, right? Sometimes you can start at the end and work your way backwards. And you do that in financing, which I think is really helpful. Are there some creative elements that you're able to incorporate into getting some of these deals done?
So there's a lot of anticipation that takes place in a deal today. It really just depends really on the type of deal. I mean, we're doing stuff in hospitality, we're doing stuff in multifamily, it can be in non-for-profit, it could even be in small HELOCs that we're doing on people's properties. The goal is really for me to see what is going on with the deal itself. Tell me, I'm looking at the variables from the borrower to the property itself. What's going on the income side of that transaction, both on the borrower side, both on the property, if there is income there. And then right now, I have a lot of lenders that we do business with, a lot of portfolio banks, a lot of family offices, many sources of capital. And I'm really having calls with a lot of those funds and banks and sources and trying to find out what they're looking for right now. What do they want to have on their balance sheet? And some are really looking, they want hospitality. Some are looking for, they just want multifamily or multifamily that's being repositioned where people are building ADUs in the back and adding units to create more cash flow to make more sense. Literally right before our call, I was on a phone with a group out of Arizona looking to do a $4 million mezz piece behind a development in San Bernardino using an apartment building that's very complex. But these are people I haven't spoken to in 2 years, but they have a very specific niche that they do. And they were just deployed today and coming into this transaction. So I look to find out more about what my lenders are looking for and really make that great connection between the borrowers and what they're looking for. And again, of course, is the creativity and making sure everything underwrites and fits properly. But that anticipation, those relationships that have been built and continue to be built for many years, they're coming into play in this type of a marketplace, especially right now.
Yeah. Yeah, and if I recall correctly, 2022 was a phenomenal year for you and JDM Funding, right? That was a really good year for you guys.
We had a great year in 2022. I mean, through COVID, thank God. We've worked hard. We've been pounding the pavement. I would say 2022 was probably one of the most challenging years I've had in this business, just because of the changing environment and how fast it was moving. People didn't anticipate the rates moving that quickly. People didn't believe that the rates would stay like that either. So people were holding off. You know what? This is no way this is real. And then 30 days later, they're up another 50 basis points or another 60 points. And there was this culture shock. There was this people that have only been doing real estate in the last 4 or 5 years have never seen interest rates in 7, 8s, 9s, or whatever else are out there. So they're used to the 2s and the 3s, thinking this is real. I mean, today you're getting on your money in the bank almost 4% on just money sitting in the bank. That's more than what you're paying on your mortgage a year ago. Think about that concept. So last year was difficult. As far as time wise, I would say it probably took 10 to 20 times the energy to get deals done, to work them. Sometimes they didn't work out. We had to redo them again. Negotiations, finding pathways between creating that medium between the borrower and the lender. 2023 is turning out to be the same way as well. Just more effort, more time. Some lenders are not lending at all right now. So it's making that environment more difficult, especially as, again, we're seeing again, the values come down a little bit, cap rates are going up, and that's putting pressure on all sides as well.
Yeah. So what are you seeing, I guess, continuing on in that same thought? What are you seeing in terms of lending velocity now? Is it still a lot of deals getting done, or is it slowing down quite a bit? What are you seeing there?
It's very interesting. January was very slow. February, we started seeing some action again. I would say in the last couple of weeks, our pipeline has grown probably 5 times just in deals that are coming in. I think there's a reality that's finally settling in where this is the environment. This is the way it's going to be. If we want to do business, this is what the environment we're going to have to do it. So I anticipate a great year. I know it's going to take a lot. We're actually hiring right now. We're trying to hire another commercial loan processor, hire some loan officers to mentor that we can bring into the same value of what we do for our clients. I just know that we all have to be patient. And it may not be hitting grand slam home runs. It's all about hitting singles and doubles and just staying the course. And I think everything will work its way out. If as long as you're doing good business, building good relationships, taking care of your lenders, taking care of your borrowers, being a source of information. It doesn't always mean we have to close a deal. Perhaps it's just answering what's going on, giving people feedback, giving them good advice. Sometimes the advice is to do nothing. But trying to protect people from themselves to a certain point, I think that's going to all come to play. And again, I'm anticipating a strong year as well.
Yeah. Okay. Are there some economic indicators that you track and look at in terms of metrics, like, or things that you follow?
I think some of the common that everybody should be looking at are the treasuries. We're constantly looking at the indexes and how they're moving. The Feds are not done raising rates. We're anticipating another 25 or 50 basis points in the next couple of weeks. Track the jobs report. We just had a cooler jobs report the first time in a couple of years. So that's giving you some indication of what's happening in the market. Things are going to slow down. So I track kind of those indexes, jobs report, look at overall trades of what's happening, what's closing out there. And then I watch what banks are paying for the cost of their funds. So if a bank is giving you 4% on your money, they're not going to be able to lend it to you less than 6 or 7% because they've got to cover their cost of capital, pay the depositories, pay their admin. So it's just telling you kind of where that market is at the moment.
Yeah. So where do you see things going? You mentioned 25 to 50 basis points this next round is kind of what you're expecting. Where do you see us landing, let's say, by the end of the year?
There's so many different platforms of lending. I mean, if we were to just categorize them and keep them general, I mean, the 30-year fixed in the residential market right now is around 7%. If I were to guesstimate by the end of the year, I think we're going to probably be in that same area, somewhere between 7 and 7.5. I don't see it really coming down. It also, you're getting into elections coming up. The politics will be out there as well. So I don't think they want to shake things up too much either. But I would expect that to be kind of where we are now, maybe a little bit higher by the end of the year. As far as like apartment buildings and commercial industrial stuff that we see on a conventional level, interest rates are now in the sixes. I think that's where we're going to see them stay. Mid sixes, low sixes, high sixes for your average 5-year ARM product. Hard money has gotten more expensive. So typical money that may have been somewhere between 7 and 9 is probably between 9 and 11, probably closer to 10 as the average for a first trust deed. Second trust deeds, which were usually 10 to 12, are probably in that 12 to 15 area. And then depending on what type of transaction may have an effect. HELOCs are trading at prime +2 on average right now. Prime is 7.75, so you're around 10%. Fixed rate seconds are in the 13 to 14%. Those sound like hard money rates, but those are what's happening out there. I expect where we are right now, we're going to pretty much stay within 50 to 75 points by the end of the year, unless something crazy happens in the marketplace. And with the last 6 to 8 months, it's definitely possible, you know?
Yeah, it's definitely volatile times right now. I don't know if this is outside your purview or not, but what about inflation? Do you see that tapering off more, or you have a feeling on which direction that might head towards the end of the year?
I mean, I think it's going to come down because just naturally the way the Feds have attacked housing, which is the biggest, it's so difficult to gauge the inflation because there's so many things that are included and not included. I mean, I would anticipate that we're going to be in a cooling period. I just don't know how fast the Feds are going to be able to get their hands around it.
Yeah. Okay. Cool. This has been super, super helpful. And I always love talking to you about all this stuff. If people wanted to get in touch with you, or let's say someone who wanted to join JDM, you said you are hiring, what's the best way for people to get in touch with you?
So you can always call our office. Our phone number here is 310-231-9300. Our website is jdmfundingcorp.com. I'm always available, happy to talk to people, happy to interview people. I'm looking to mentor a couple of great loan officers out there, bring them under the wing, give them some of that 20-year gray hair experience and help them build and have the same success that I've had. And in general, we also do a lot of community work. We're always involved out there. So reach out for anything that you need. We're happy to support.
Cool. All right. And any other last thoughts for people that are thinking about a loan or on the sidelines for getting a loan? Any ideas for those people?
I think to answer the most common question that I get every day, should I buy this house right now, would probably be the top question. And the answer is yes. Because if you're able to afford the property the way it is, and you can make those monthly payments, make the move. Better to buy a property in a more depressed environment at a higher rate than to pay a higher price and a lower rate, because eventually this will pass. What will the final interest rates be in a couple of years? I'm not sure, but at least you're going to get a better deal. And number two, your home is not a typical investment that you're going to trade, meaning if it goes up a couple $100,000 or goes down a couple $100,000, you're not selling it either way. It's where you live and you come home every single day. So as long as you can afford it and you can make sense of it, I'd encourage it and definitely participate. There's a lot of business that is being done right now. You just have to be savvy and surround yourself with a great team. Talk to people, get information, and don't be afraid of 5, 10, 15 grand one way or another. At the end of the day, in 3 or 4 years, that won't affect that property whatsoever.
Yeah, I agree. Well said. I like to say in the commercial world that you marry the property, but you date the debt, right? I'm sure you've heard that
Good
one.
line.
So, if you don't like the debt later on, you change it up, but you marry the property. That's really what you're getting into it for. So we do the same thing here at CSQ Properties and on the commercial side. And yeah, we're still buying and still active in the space, paying really close attention to the debt, of course, which is why I really wanted to get you on the show. But yeah, there's still a lot of deals to be done and money to be made in real estate. So we're excited about that.
I think there's so many unique deal makings happening on every transaction right now that there isn't this status quo or, oh, it's this type of property, therefore it must be this type of financing and this is the way it is. I'm getting some of our credit unions to do things that they've never done before. We're helping them write some of their own terms for their offers to us. But you're never going to get it if you don't ask and you don't know what to ask for. So I always say is don't make assumptions, get out there, work it, and you never know what you can actually come up with in a transaction.
Yeah, look, it's interesting you say that because I never thought I'd be with a credit union, but that's who you found for us on that medical building loan was a credit union, and it's been great. So it's definitely something to be said about getting creative and finding who has an appetite for what type of deals, because there's definitely still an appetite out there.
Yeah, it's awesome. I mean, ideally, you just need to find out what the source of capital needs as well, and to start working that together.
Yeah. Awesome. All right. Well, thanks so much for sharing all your wisdom with us, Josh. I really appreciate it. And we'll see you on the next show.
I'm looking forward to it. Chad, thank you for the opportunity as well.
Thanks, bud.
All the best. Bye-bye.
I hope that was helpful to hear from somebody who's doing a lot of deals right now on all different asset classes. If you'd like to hear more from CSQ Properties, click the subscribe button below because we put out a lot of good content with a lot of great guests. And if you're interested in investing with CSQ Properties, definitely check us out at csqproperties.com or on any social media channel at CSQ Properties. Thanks a lot.